If it sounds too good to be true, it probably is, and the 5 stocks we're talking about in this video are certainly no exception to that, and are honestly ones you should never buy again. All 5 of these stocks are ones that I would consider to be yield traps. They each offer ridiculously high dividend yields, but have a terrible track record of being able to sustain them, and ultimately end up having to slash those dividend payouts or eliminate them altogether. And the first yield trap on our list today is Agnc Investment Corp, which is a mortgage REIT or an MREIT that basically has a portfolio of mortgages and other mortgage-backed securities that it acquires and generates income from. And Agnc is down across all time periods. In the last year, they're down 12.25%. In the last 5 years, they are down a whopping 48%. And if we zoom out across the last 10 years, they are down almost 56%. So the share price has done nothing. And outside of Agnc's high dividend yield, which is currently sitting at about 14.5%, I just don't see why anyone would want to buy this stock. Taking a look at the dividend history across the last 5 years, it looks like Agnc has made numerous reductions to the dividend, taking it from 18 cents per share in 2018 all the way down to 12 cents where it's at now. And so this dividend is going down at a pretty aggressive rate. If we look at the 10-year dividend growth CAGR, this is sitting at almost minus 12%. That's no small number. So not only is the value of your investment going down over time, but your income is diminishing as well. And this is the exact opposite of how you want to see your investments behaving. And I think it's especially important to hone in on this particular company because people see that high 14% dividend yield and just buy it based on that one dangerous factor alone without doing any further investigation, and I just don't think that's the right way to go about it. Anyway, moving on to this second stock, which I'm also not a big fan of. This one is Zim Integrated Shipping Services, which is a cargo shipping company based out of Israel that has seen a tremendous increase in popularity for their 100+% dividend yield, and I'm not even kidding. Their dividend yield is sitting at about 133% for the trailing 12 months, but this dividend is all over the place, guys. Looking at the dividend history, we can see from this chart that things are pretty sporadic. They had that one really big payment last year in March for $17, which is what first made this company super popular, but then the dividend payments have gone back down. They're still pretty impressive, but like I said, overall it's pretty sporadic. And within the last month and a half, they actually announced a complete cut to the dividend as a result of lower freight rates and weaker demand for the quarter that wouldn't allow them to cover the dividend payment. Their policy is to pay somewhere in the range of 30 to 50% of their annual net income as a dividend, and so because they took a net loss of $58 million for the quarter, which was exponentially lower than this time last year, by the way, but anyway, due to this quarter's loss, they had to cut the dividend. And upon making this announcement, right about here on the share price chart, the stock went from about $18 per share to where it's at now, about $13.50 per share, so quite a big drop. And overall in 2023, things are not looking good for Zim. They are down about 21%, but if we zoom out across the last year, look at this, guys. They are getting beat to a pulp where they are down about 70% in share price. At any rate, depending on how the company performs moving forward, they may bring the dividend back, and I know a lot of people out there still like Zim, but I personally can't get behind it. When they do pay a dividend, there's no denying that they pay big, but I just don't like how spotty it is. I more so look to invest in things that have a better track record of sustaining and growing their dividend, even if it means missing out on a 130-something% dividend yield. I think that's a fair trade. But anyway, this brings us to the third stock. This is Armor Residential REIT, ARR, which is like Agnc in the sense that it's a mortgage REIT and it makes its money, or at least tries to, by investing in various mortgage-backed securities. And like Agnc, this company is a certified yield trap. Once again, guys, we are seeing a ridiculously high dividend yield sitting there at 18.5%, but look at that 5-year growth rate. On average, over the last 5 years, this company has reduced its dividend by an average rate of 13.25%. And looking at the dividend history chart across the last 10 years, this is the literal opposite of what you want to see. This company is paying one of the most unreliable dividends I think I've ever seen. 10 years ago, you were getting 64 cents per share on this company's dividend, which is 8 times, or almost 8 times, what you're getting today, only 8 cents per share. I can't believe it. And once again, across all time periods, you are losing so much value in terms of share price. And last year, you are down 27%, but in the last 5 years, you are down nearly 80%. 80%. Honestly, guys, besides the dividend yield, I seriously don't understand why anyone would want to invest in a company like this. I don't get it. In fact, I think that's a pretty good way to gauge whether or not you're looking at a yield trap. If you've got a stock and you can't come up with any other good reason to be bullish on it besides, oh, it pays a big dividend, then it's probably best to move on. Just don't invest in it. Anyway, before I get too flustered, we should probably just move on to the next stock. This one is PSEC, which is a business development company, kind of like a Main Street Capital Corporation or an Ares Capital, who acts as a lender and investor for middle market companies, but I don't think PSEC is of the same quality as Main or ARCC, and their dividend certainly is not as reliable. No surprise, PSEC has a high double-digit dividend yield, 11.4%, and looking at the 5-year 5-year growth rate, this is going down, guys. Not as bad as the last stock, but they are still diminishing this dividend by an average rate of 1.25% every year across the last 5 years. Looking at the dividend history chart across the last 10 years, like I said, it's not as bad as some of the other companies we've seen, but still this is trending down, which is something that we do not want. And 10 years ago, you were getting 11 cents per share for the dividend compared to today, you're only getting 6 cents. So it's been almost cut in half. Now, comparing this to Main Street Capital Corporation's dividend growth chart, this is looking a lot better. The growth isn't super aggressive, but it's there. Okay, they are growing this dividend over time, which is much more preferable to what we saw with PSEC. And like I said, PSEC's decline in dividend is not as drastic as what we saw with some of these other companies, but it is still trending downward. And so I technically think it does constitute it as a dividend yield trap, at least in my book. And once again, I don't know why anyone would want to invest in a company like PSEC when there are so many other great options out there in this space. There are tons of other great business development companies like the ones we mentioned, Main Street Capital Corporation and Ares Capital. Those are much better choices if you were looking to invest in a business development company. Just go with one of those. Anyway, guys, this brings us to the 5th and final stock of the day. This is Annalee Capital Management, NLY, which is yet another mortgage REIT, and I'm afraid it's just the same old story, guys. Here we've got another high yield, 13.3%, and they are diminishing that dividend by an average rate. This one's going down by 8.6% per year on average over the last 5 years. This is what the dividend history chart looks like across the last 10 years. So you can clearly see it's going down. And 10 years ago, you were getting $1.80 per dividend payment. Compared to today, you're only getting 65 cents. So the dividend has been cut by 2/3 in the last 10 years, and the share price performance isn't any better either. Just in the last year, NOI has dropped about 19%, but in the last 5 years, they are down over 50%. Now, in my opinion, all of these stocks are no better than big fat yield traps. And if I was you, I would never buy them again or ever buy them at all. And that goes for any other company or fund that shares these same characteristics. I understand how tempting these high yielders can be, and don't get me wrong, there are some really great high yielders out there, but the yield alone is not enough to merit a long-term investment. And that's the lens you should be using when you're looking at these stocks. Everyone wants to live off dividends as fast as possible, and I want the same thing, but there's a better way to do it besides risking your money with these yield traps. And in this next video right over here, I'm going to show you a better way. I'm going to show you how you can live off dividends in 15 years or less. It's no joke, and it's not going to be easy, but it is possible. So click right over here to learn how, and I'll see you in the next one.